Hello friends. In this video, we'll talk about two of the stocks from electronics manufacturing space, Dixon Tech and Kaynes Technologies. Both of these stocks have done pretty well in recent few years. Dixon Tech is incorporated in 1993. It is into manufacturing of consumer electronics, lighting, home appliances, closed circuit television cameras. It also manufactures security surveillance equipments, wearables, audibles, AC PCBs. And recently, it has entered into a joint venture with Imagine Marketing Private Limited for designing and manufacturing wireless audio solutions in India. Uh, Dixon is one of the largest LED TV manufacturer and has more than 35% of India's requirement. It is largest ODM player in lighting and has largest capacity in various SKUs. With around 160 models in the semi-automatic category, the company has the largest product portfolio ranging from 6 kgs to 16 kgs. So, Dixon Tech is into the manufacturing of various electronics equipments, and because of government's recent push to have electronics manufacturing done in India, companies like Dixon, Kaynes have done pretty well. If we talk about Kaynes, then it's a leading end-to-end IoT solutions enabled integrated electronics manufacturing company. It also provides conceptual design, process engineering, integrated manufacturing of various for various major players in different sectors. It is a leading end-to-end solution provider with capability across entire spectrum of ESDM space. So both of these companies are into electronic manufacturing with China plus one strategy. Many of the manufacturing, especially related to electronics, have gradually shifted to India. We could see iPhones are also getting manufactured in India, a large chunk of it, and overall the trend is developing, and companies like Dixon and Keynes are beneficiary of this trend. Now we'll have to see which company becomes a leader in this sector. But if broadly the sector itself is growing, then we can expect all of the companies grow together. Some may do well, some may relatively not. But by and large, there will be a rub-off effect of overall growth in this sector for each company. If we talk about specific news related to Dixon, then there was a sharp fall in their stock price in recent few days, and the reason being entry of Tata Group. So Tata Group is also investing $18 billion in the field of manufacturing. So there will be a competition, and because of that, market reacted. Somewhere market felt that companies like Dixon, CG Power, Keynes will get impacted because of the competition, since Tata also has skin in the game, and they can invest heavily and can give tough competition to these players. Also, there was a delay in PLI subsidy. Uh, the reason cited by Dixon Tech chairman was that of a technical issue, but that was also one of the reasons why stock was under pressure in recent few days. And overall market sentiment itself is not good. That is also having an impact on these stocks because these stocks are trading at a very high PE. If we talk about news specific to Keynes, then mostly the news are related to the stock price movement. Many of the fund houses and brokerages have given uh, a thumbs up rating to this stock and have in fact predicted an upside for this stock in 2025. But valuation is something which is a risk factor for these stocks. If you compare both of their market cap, then Dixon has a market cap of around 1 lakh crores, whereas Keynes has a market cap of around 42,000 crores. But valuations for both of these stocks are pretty high. For Dixon, it's 179, and for Keynes, is 229. So valuation is the only thing which is concerning. Other factors related to heightened competition and some prediction by analysts are something which goes on, but valuation is something which does have an impact. We saw what happened with DMart when growth rate has tapered, then we saw a huge drop in its share price. So even if there is a slightest miss in case of Dixon and Keynes also in terms of quarterly result, then will see that will have an impact on their overall stock price. It happened with IT companies during dot-com bubble. Uh, uh, Valuations were so high, and because of that, when bubble burst, then stock price went down heavily, and it took years for them to come to the levels which were there during the dot-com bubble. So these things can happen, so investors have to be very vigilant about this. uh, if we talk about these two specific companies, then ROE, ROC numbers for Dixon are relatively better compared to Keynes. Dividend yield for both of these stocks are pretty low. Mm, The reason for it is mainly that they are finding so many opportunity to invest and grow their business. So they think that instead of giving out cash as a dividend, we can very well invest in it for the expansion plans. And as we discuss relative valuations, we can see that for both Dixon and Keynes, their current PE is above their historical average. Historical average itself is pretty high, 118 for Dixon and around 134 for Keynes. But again, it is trading at PE, which is above their historical average. Though they are doing very well in terms of profit growth, but valuations have surpassed the growth which they have delivered in terms of profit. Uh, if we talk about actual numbers, then CAGR sales growth for last 5 years was 43% for Dixon, and profit growth was 42%. So growth numbers are pretty good, no doubt about that. But stock price CAGR have surpassed their profit growth, and by and large, CAGR growth is CAGR stock performance is a reflection of stock's profit growth. So there is a possibility of mean reversion, as we discussed, uh, in these stocks. Similarly, for Keynes, the CAGR for last 5 years was 29% when it comes to sales, and 68% when it comes to profit. So margins have improved as well for this company, and the sales and profit numbers are consistent as well. If we discuss their technicals, then for Dixon, stock is following an increasing trend line. It is taking support. It has not broken down, though there was a fall from its all-time high, but still stock has not broken down its trend line support. We'll have to see how it performs going forward, especially during and after quarterly results. But so far, this trend line is acting as a support for the stock. Similarly, for Keynes also, increasing trend line is acting as a support for this stock. It again has not broken down despite a recent fall. Again, for this stock also, quarterly results are something which we'll have to see. If there is even a slightest miss, then there is a high risk of stock price going down further. It can also lead to a breakdown, but yeah, results are something to watch out for. Remember, friends, this analysis is only for the educational purpose. Kindly do not consider it as a buy or sell recommendation. Please consult your investment advisors before taking any buy or sell call. Thank you.